Thank you so much, Anna. Let's get the thoughts of Emily Sanders, Chief Investment Officer at Sanders Financial Management. She is going to be joining us for the rest of the show. Emily, thanks for talking to us. So, Emily, I want to get your thoughts on that discussion. Get your thoughts on the discussion we were just having there. What do you make of the impact of the IMF talks breaking down with Hungary? What kind of impact do you see that having on the markets?
It's really not surprising. It's been a constant saga with Greece, and then today the Ireland downgrade by Moody's, which is peripheral to the IMF, but still indicative of just weakness throughout the euro zone. So really what the gentleman from the bank said, that eventually the Hungarian government is going to have to accede to the IMF's demands, totally makes sense. It's just a question of when and how that plays politically within Hungary.
I also want to get your thoughts on what we saw in the U.S. markets on Friday. We saw consumer sentiment, consumer numbers really dragging down the U.S. markets. What do you make of that turn for the worse?
It really seems just part and parcel of the very weak economic growth. You know, the U.S. downgraded the forecast of GDP growth now to 2.6, 2.7%, and the unemployment is persistently high, and that really puts a drag on consumer spending. Even it was reported that the wealthy are slowing down on their consumer spending at this point. There's uncertainty about tax rates in 2011, and businesses, particularly small businesses, are really holding back on hiring. So with all that uncertainty about what the future year is going to bring, it's just not surprising at all that consumer sentiment is low, and that consumers are tightening their wallets a bit more than they were during sort of the bounce back of the market in late last year.
Now, we saw some fairly positive earnings numbers on Friday, but the attention really was on the negative economic numbers. Where do you think the focus is going to be? Is it going to be on the earnings reports, or is it going to be on the economic data?
Well, considering that there are so many earnings reports coming out this week, a large portion of the Dow, many S&P 500 stocks, and it is expected that the earnings will be good, I would think that the focus would be more on earnings than on macroeconomic figures. However, once the earnings season starts coming to an end and drawing to an end, the focus again will be on the economy. As we even saw in the dollar weakening, there is now renewed focus on the U.S. and the fact that our economy isn't in such great shape either. We're plodding along at sort of a slow recovery. We have not had a double dip, and we don't forecast a double dip, but we do see a double dip coming in 2011 in the housing market, and that could further complicate things for the U.S. economy because it is so dependent on real estate.
In terms of, so you're expecting a double dip in 2011. What was interesting is that recently we've had people like Alan Greenspan talking about a sharp reversal in the yield rates. Of course, the 10-year yield currently at just below 3%. What do you think is going to trigger that flip so that the yields get higher and makes the economy in a much more difficult place?
There's really nothing on the horizon right now that would trigger that flip. Rates are persistently low, and the Fed has signaled that they're not going to raise rates from their end for at least another year. I mean, they didn't give a timetable, but between the lines, it seems clear that the powers that be in the Fed, minus the dissenting voices, feel that rates should continue to be low. And there's also a lot of pressure from Congress to keep rates low rather than stall a very fragile recovery. So really, the double dip in housing that I referenced has more to do with the shadow foreclosures. Realty Track estimates there are going to be 1 million foreclosures this year on residential homes. That's 10 times the normal average. There were 900,000 last year. But banks have been withholding on the foreclosures, and at this point, they've got to get some of those homes off their books. And when that starts to trickle into the market, it's going to cause further depression on housing prices, perhaps not as much as we saw from 2007 to 2009, but we do expect lower housing prices in 2011.
Emily, we're going to have to leave it there for now, but you're sticking around, so we'll get to finish this conversation. Emily Sanders, thanks so much for joining us. Still to come, will BP ever seal the leak? The latest on the disaster in the Gulf, plus those reports on a possible breakup of the huge oil giant. And here's a quick look at how oil is trading as we head into the break. The U.S. economic calendar is heavy with housing data this week. Today we get the latest sentiment index from the National Association of Home Builders at 1 p.m. Earnings also pick up this week with a dozen Dow components and a quarter of the S&P 500 companies reporting results. Today we hear from Delta Airlines, Halliburton, and Hasbro before the opening bell, IBM and Texas Instruments after the close. Emily Sanders of Sanders Financial Management is still with us. Emily, what do you expect to hear from these companies today in terms of earnings, especially the tech companies, IBM and Texas Instruments? What are you looking for?
Yes, Julia, we're looking for a good report from IBM, similar to Accenture last week, that is in a similar space in terms of the IT consulting business. So we're looking for some good news after the bell today that may prop up the market on Tuesday.
And what about the home data we're going to get? We have the Home Builder Sentiment Index, also home sales and housing starts coming later this week. I know we've gotten a lot of negative info on the home builders so far. What are you expecting to hear now?
We're expecting more of the same, Julia. The home sentiment is pretty awful, and for a variety of reasons, new home building is extremely slow. Individuals who are looking for mortgage applications has hit a very low level despite the rock bottom interest rates. And as I mentioned earlier, there are shadow foreclosures that are just continuing to depress the price of homes. So people have the expectation that if they wait a bit longer, the prices may actually get lower. And additionally, with the expiration of the homebuyer tax credit that Congress may or may not renew, without that additional stimulus from the tax code, it appears as if home building and home buying will be especially sluggish for the foreseeable future.
Do you expect that data to have a negative impact on the market, or do you think it's already factored in?
I believe it's already factored in, but if it goes on like this for months and months, since the homebuyer credit expired in April, the news out of the housing front has continued to be gloomy. And I do believe that eventually Congress will have to respond to that because housing makes up so much of the U.S. economy. But for now, the extension was passed for home closings, and once that expires finally in September, we'll see if there's any new blood in the housing market.
Great. We have to leave it there. Emily Sanders, Chief Investment Officer at Sanders Financial Management, thank you for joining us. We're going to take a quick look at the futures as we head into it. That's it for today's show. I'm Julia Borston in the U.S.
I'm Ross Westgate in Europe.
And I'm Chloe Cho signing off in Asia. Thank you so much for tuning in to Worldwide Exchange.